After starting this module, you shall be able to know what is economic analysis, know about the tools of economic analysis, how GDP is and can affect stock prices, importance about international economic conditions. Economic analysis is one of the studies that form part of the fundamental analysis. This relates to study about the economy in detail and analyzes whether economic conditions are favorable for the companies to prosper or not. In economic analysis, analysts try to find out whether the economic environment is conducive for the growth of the company or a business or a sector. An investor in a share market can give prediction about the future of share price for a share of a company on the basis of the study of forces affecting economic environment. Economic analysis implies the examination of a country's GDP, that is gross domestic product, government borrowings and loans, consumer and goods market, capital market, saving rate of economy, investment pattern, interest rate, inflation rate, tax rate, foreign direct investment, money supply and demand, etc. All these factors influence the share prices and the stock market indices. Next, we will study about economic analysis and the tools. As discussed above, it is a help for investors because if they analyze about the economy and then make prediction about its impact on share prices. Economic analysis is very important, but again a question arises that how to do economic analysis. To analyze an economy, an analyst has to study about various factors. Some of them are given below. First is gross domestic product. GDP or gross domestic product is the measure of the value of goods and services produced within the domestic boundary of a country. It ignores any depreciation. It is one of the measures of economic activity of a country. It is calculated by adding the market prices of all the final goods and services produced in the domestic territory in an year. The gross domestic product, that is GDP, is one of the most important indicators used for the measurement of the strength of a country's economy. In this, value added by each firm is measured to determine the health of the economy. For example, if a firm buys wood logs and adds value to it by making a wooden table out of it, then in GDP we will take the value of wood logs plus the increase in value of wood logs when they are changed into a table. GDP has a greater value and meaning for everyone. But in relation to investors, they are concerned about GDP growth as it determines the growth opportunity for companies to make more profit. We can understand it in this way also. That increase in GDP, gross domestic product, means increase in the production of goods and services, which in turn will result increase in sales of a company and thus increase in profits of the company. This increase in profit will lead to more returns, whether actual or perceived, to equity shareholders and thus it affects share prices. Second is fiscal policy. Fiscal policy is the policy through which government adjusts its spending and tax rates to stabilize the economy. Fiscal policy is in principle based on the thoughts of British economist John Maynard Keynes 1883-1946, who thought government could transform economic performance by adjusting tax rates and government spending. Different analysts see fiscal policy differently, and thus there are different views regarding whether fiscal policy directly affects stock prices or not. But commonly it has been stated that government spending in the form of subsidies usually reduces the cost of product and thus leaving scope for larger profit of the firm. The larger profit in turn leads to larger earnings per share. This increase in earnings per share will lead to increase in value of share prices. On the other hand, increase in taxes for the company reduces the amount of profit available for shareholders. Thus, increase in taxes has the effect of reducing the amount of earning per share and thus leads to fall in share prices of the company. Third is monetary policy. Monetary policy is the instrument of central bank of a country, that is RBI in India, through which it controls the supply of money. The main thing in a monetary policy is deciding about interest rates at which money can be borrowed. Many investors are of the view that monetary policy affects share prices if there is variance between the investor's expectation about the movement of interest rate and actual movement in interest rates. If RBI raises the interest rate, then it will impact the interest rate on debentures and bonds. With increase in interest rates on debentures and bonds, there will be change in risk perception of investors and thus they will want higher return on their equity investment. Thus, an increase in interest rate, if not accompanied by increase in return of equity, then investors will get inclined towards debentures and bonds rather than equity. This will affect the demand for equity and thus will lower its prices. Similarly, if change in interest rate is per the expectation of investors, then it will not affect equity prices to a larger extent. Fourth is saving rate. With increase in individual saving rate, there will be flow of larger funds into investments. This will result in an increase in demand for equity shares and thus share market will be bullish as it has an impact of increase in share prices. On the other hand, a lower saving rate means lesser disposal of funds by household into equity market, which will reduce the demand for equity. Thus, there will be reduction in share prices and market will be bearish. Next is trade deficit. The impact of trade deficit on economy has been a topic of discussion among economists. There are different views regarding trade deficit. Some believe that it is favorable in case of strong expansion. Some says that it is too good in times of recession. However, here we will discuss the trade deficit's impact on share prices. Trade deficit occurs when countries' imports are more than its export. In other words, we can see it that a country is buying more of foreign goods than it is selling to them. Thus, this will impact domestic producers. More imports mean more purchase of foreign goods and less purchase of domestic goods. This will result in more profitability to foreign companies than domestic producers. The lesser the profit, lesser will be the amount of profits available to equity shareholders. Thus, it will result in decline in the prices of shares of the domestic company. On the other hand, there will be an increase in the prices of foreign companies' shares. Next in discussion is exchange rate. Exchange rate is also another factor that affects the trade or net exports between the countries. This in turn will also affect the trade and business of the companies that have global presence or any company that is related to any foreign market, whether for buying raw material, selling goods or in any other way. The effect on such companies' activities or business will affect that company's profitability and hence the prices of shares. Thus, exchange rate affects share prices. Next in discussion is economic analysis, a help to investors. Economic analysis, as we have discussed, is an indicator of how changes in economic factors will influence a company. Many investors see it as a good help, whereas some take it as a tedious task to be done. However, it is a true fact that changes in economic policies and environment will affect the environment in which business is done and companies operate. Thus, a good understanding and eye on economic variables like GDP, rate of growth, monetary policy, fiscal policy, exchange rate, business cycle, imports, exports, etc. will give a valuable insight into the future of business and companies' performance. An analysis of gross domestic product and how these components are related to the performance of the industry and companies is also required. Information relating to this may be taken from researches done by others or from expert opinion. Any change in interest rate will result in number of articles and reports relating to its effect on economy. In fact, one can get knowledge about it by watching news channels, especially business news channels. Thus, economic analysis helps the investors to get an idea about the direction of change in the capital market, as economic analysis deals with forces operating in the overall economy. Economic analysis has an important role to play in the investment decisions. In fact, in this era of globalization, when businesses are no more operating in domestic arena only, it is very important. Then one should also study international economic environment and situation to make a good judgment. Types of economic analysis. Policymakers have a variety of economic analysis at their disposal to help them assess policies and programs. Cost analysis, fiscal impact analysis, cost effectiveness analysis, and cost benefit analysis are among the most commonly used tools. This document describes these four types of economic analysis, compares and contrasts them, and explains which circumstances warrant their use. Cost analysis. Cost analysis provides a complete accounting of the expenses related to a given policy or program decision. It supplies the most basic cost information that both decision makers and practitioners require and forms the foundation of all other economic analysis. A cost analysis sounds simple, but it requires effort to perform a cost analysis thoroughly. Analysts frequently identify only the most obvious cost, such as staff salaries, and fail to account for many others. Fiscal impact analysis. A fiscal impact analysis is a comprehensive study of all governmental revenues, expenditures, and savings that will result from the proposed policy or program. State and local fiscal offices routinely produce fiscal impact analysis, which are also called fiscal notes when they are prepared for draft legislation. This type of analysis helps policymakers determine whether a proposed initiative is affordable from a budgetary standpoint. Cost effectiveness analysis. A fiscal impact analysis can help you assess how a program or policy will affect your budget, but it won't tell you whether the program or policy is an efficient use of resources. There may be less expensive options that produce equivalent results. To evaluate which program or policy creates the result you want at the lowest cost, use Cost Effectiveness Analysis (CEA). Cost Benefit Analysis. Cost Benefit Analysis (CBA) is a method for comparing the economic pros and cons of policies and programs to help policymakers identify the best or most valuable options to pursue. A characteristic feature of CBA is that it monetizes or puts into dollar terms all the benefits and all the cost associated with an initiative so that they can be directly compared. Policies and programs whose benefits outweigh their cost generate net benefits. Now, let us summarize what we have discussed so far. Economic analysis is one of the elements of fundamental analysis. It helps investors to make predictions about capital market on the basis of the knowledge of economic variables like GDP, monetary or fiscal policy, exchange rates, interest rates, saving rates, etc. Changes in economic policies and environment will affect the environment in which business is done and companies operate. Economic analysis is a help for investors because if they analyze about the economy and then make prediction about its impact on share prices, it is an indicator of how changes in economic factors will influence a company. The success of this analysis depends on the accurate predictions by analysts.